The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to a special episode of Honest Money. We're doing something which I always kind of shy away from doing, and that's talking about very current affairs in a time and an environment where the world is particularly unstable and uncertain. And the reason we're doing that is because I just feel like whether you're a South African, a Ukrainian, a British person, a Canadian, a Mexican, even an American, you're living in a time when the political world is being turned upside down, inside out, and any other direction I could think of at the moment. And so I thought it was time to bring one of my favorite guests back on the show, Rupert Hare. He is head of multi-asset at Prescient Investment Management. Rupert, thank you so much for joining us.
Thanks, Warren, and thanks for the compliment.
So Rupert, it just feels to me like we're not living in normal days, normal times. It's not just another market event, fueled by maybe an overvalued sector somewhere, and I feel like I know how to navigate most market events, but we are living in a time where it feels like the world order is being changed somewhat. I won't say it's a first. It's certainly, we've probably seen this in the decades past, but I will say for many of us, especially people kind of under 40, it's probably a time where we're seeing a reordering of global relationships, and it's not being driven, in my view anyway, it's not just being driven by Donald Trump. I think Donald Trump might be more of a symptom than a cause of the change, but we are living in major change. And understandably, investors are looking at this and saying, what do we do now? How do we manage our money in an environment like this?
Sure, if I had a crystal ball to tell you exactly what's going to happen in the next 6 months, then wouldn't that be a fantastic thing? But I think that what is interesting is the saying goes, history doesn't repeat itself, but it certainly rhymes. And that's something that we are seeing at the moment first thing is that Donald Trump has been the president of the United States before. And the second thing is that we've seen this, as you said, perhaps not in the last 40 years, but we've seen it before globally. If you go back through the centuries, we've seen a shift in power again and again and again. And if you have the time to wait, you are going to see a shift in power during your lifetime.
So when you're in an environment like this, I think you're right to say it's not unique. It's not specific to one moment in time. And even for you, if you're driving your investments and it's new to you, I suspect there is a lot we can learn from the way that markets have moved in previous times. And maybe very especially the mistakes people have made in the past, and looking at their investments differently. And I suspect that's maybe the first thing to say is when there is so much uncertainty and the news flow is so loud and being thrown at us all the time, we could be tempted to change our time horizon of our investment views. In other words, we suddenly start to worry about next week and next month instead of next 5 years and next decade. And I wonder if that's an appropriate reaction to a time like this. Should we be shortening our time horizons?
So I'd say there is definitely merit in keeping an eye on what's going on in the world. But, news sources like to sell news. And that's the one fact that we do know, right? So they'll often inflate news around a certain event or a certain person beyond what it really should be. So what we do is we try and focus on the facts. And if you look at the facts, that's things like financial statements, growth prints, survey data even. And if you look at those sorts of facts, then we can see that a couple of things on the United States. Let's start there. So opinion polls on Donald Trump were elevated when he first took on power. Now they're starting to see a bit of a waning, a little bit of uncertainty there. US equity is extremely, extremely expensive on the back of the Magnificent Seven having rallied so hard. And they continue to grow significantly. But the question on everyone's minds is, are they growing enough? and we've had disruptors like this DeepSeek model coming through from the East, from China, showing how they can export, let's think of it that way, export some sort of machine learning algorithms or systems at a fraction of the cost. Now, we've seen this before, right? We've seen this in the manufacturing sector when the US used to be a manufacturing powerhouse, and then that shifted to China at a much, much lower base cost. So I think people are starting to re-question or take a step back and say, okay, well, is it realistic that companies are trading on more than a 50 times PE ratio with a growth assumption of, let's say, 50% a year for the foreseeable future, when you could have something coming in and undercutting that margin? So a lot of questions on everyone's minds. A lot of what's been interesting is there's been a lot of realized market volatility. In other words, on the day, the market goes up and down based on, let's say, the Twitter feed of Donald Trump or whatever it might be. But the implied volatility, not to just briefly explain that, the implied volatility is essentially the cost of insurance on your portfolio. So what we use implied volatility for is to measure whether the market is skittish in advance of the market actually taking a different path, right? So what I wanted to mention on that is that implied volatility at a time when US equities are extremely, extremely expensive and growth assumptions are hanging on tenterhooks, implied volatility, in other words, the market perception of risk, is incredibly low. So put those all in the same cauldron and mix them together, and you get a market which is, it's been growing strongly and steadily for the last 2 or 3 years, but it does so on the edge of a precipice.
I'm sitting here listening to you and thinking to myself, one could be forgiven for drawing a parallel back to the year 2000, somewhere around there, the tech bubble bursts, largely caused by unrealistic expectations. And then when those unrealistic expectations are not met, surprise, surprise, people get disappointed and they sell. And if it was that simple, then this investment business wouldn't be that difficult. The problem we've got is those were companies at that time that were selling clicks. They were getting views, and they weren't necessarily generating a huge amount of revenue. They certainly were not profitable, and in my view anyway, not very cash positive. They didn't have very strong balance sheets. Now we're living in an age where Apple sits on this huge amount of cash. Microsoft, the same, very cash flow positive, very cash generative businesses. In a way, they could buy themselves a lot of time if markets turned against them. Certainly, the CEOs of some of these very big tech companies are incentivized on an earnings per share, and that's important because if the share price implodes, they can use their cash piles to buy back their shares, which would be great for their incentive schemes and for the remaining shareholders. We could argue whether it's good or bad action, but it feels to me that yes, this rhymes with the last time, but in a way, just with those tech shares that are phenomenally overvalued, I agree with that they're very different kinds of businesses because they are so big and from a pricing power point of view, currently very powerful. And I love the DeepSeek analogy because it doesn't mean they're going to be around in 5 or 10 years, and if they are, they might not have the pricing power they have today because they could be innovated into a commodity product or innovated out of existence. So it does feel to me we've got to be a little bit careful about being complacent that this looks exactly like the year 2000. It doesn't, but that eventually, I guess I'm going to preempt your answer. Valuations always count. They always count.
Took the words out of my mouth. You mentioned price a couple of times there. So you can look at the fundamentals all you like, and you can have a very, very strong balance sheet for a company. But if the price isn't right, if the price is too high, you're paying too much for that balance sheet, even if it is very cash flush, it's just not worth taking on that risk because you are, from a price perspective, leveraged towards earnings. So if your earnings disappoint on the downside, then you can have a massive sell-off in that particular stock. And that's not to say, and I mean, don't get me wrong, I'm not saying go 100% out of US equities or global equities, or I'm just saying that at the moment, there is a significant headwind towards US equities from a valuation perspective. And then if we look towards the political aspect, the one thing that we can measure at least is complacency within the market. And if we have a combination of a very highly or overvalued asset class plus complacency, that's somewhere to start taking a bit of risk off in the portfolio. And let's be honest, we've had great returns for the last couple of years. Those who have piled into the likes of Nvidia, Microsoft, Amazon, they've had fantastic return profiles. So perhaps a good time to cut a bit of risk.
And I think that's the measured response people need to have to something like this, is you can't be all or nothing. So it's now evident valuations are high. It's evident that that lots of people have been well rewarded for being in the big tech shares. But at the same time, taking some of your profits, I don't think people regret taking some profits and allocating them elsewhere if they invest them. And I want to come back to that, because it's all good and well telling me to take some profits here, Rupert. It's what do I do with it on the other side? Where am I deploying this powder that I've just created, the dry powder? So I agree with that. I think you need to be measured if you're investing your money. Is okay. I've listened to these honest money people, and they're telling me that tech shares are expensive. Good. America's complacent from an investor point of view. Take the point, reduce my US exposure, but that doesn't mean you go from whatever the index is, 65% down to zero. That's not, no one's saying that. I shouldn't be judgy, but no one sensible that I would listen to is saying that. So they're not on the show for a reason. And I think the point there is reduce your exposure. So what's next? What do you do with that capital that you've realized from those very profitable trades?
Yeah, I think as always, it's about a needs assessment. So if you think of yourself having gone into this scenario with, as you said, 65% US equity exposure, US equities have rallied significantly. Now your weight's 75%. Now, it's not really a decision, or it's not a difficult decision to bring your US equities back down to 65%, because that's how you originally wanted to position your portfolio structurally. So that goes back to the needs of an investor. Let's talk about equities versus fixed income in general. So how much equities versus fixed income, growth assets versus more defensive assets do you want within a portfolio to align with your needs? And that's the key here. So you're trying to say, okay, they're actually pretty high yields. Well, two asset classes I'm going to cover here. So they're pretty high yields in SA right now. Fixed income markets in the bond space giving us around 11% yield profile. It's not expected returns, but it's yields. So strong yields with inflation sitting at around 3%. And that's hasn't happened in quite a long time. Same time, when I went back to the US equity case, where there was this highly overvalued market running on extremely ambitious growth assumptions, in SA, we've got arguably an undervalued market running on neutral growth assumptions. Now, for us, that's an area that could see improvement. So if we see SA growth going above 1, I mean, let's be ambitious, let's say 3, 4, 5% real growth in SA, can always hope. Then you've got an SA equity market which is positioned for a great rally. So what I'm saying is that stick to the nature of your portfolio. So if you've got equity exposure, then your portfolio has been designed by, let's say, a financial advisor to have X% equity exposure, rather than just selling down your equity exposure, as you say, to zero, rather look for other opportunities in the equity space. And if there are no opportunities at all, then start looking a little bit lower down the risk spectrum. But remember that you get paid to take risk in investments. That's how it works. So through the long term, you get paid to take on risk. Otherwise, why would anyone invest at all?
So I want to touch on a couple of points there, Rupert. One, I'm making the assumption, not putting words in your mouth, that we're going to be in an environment where global interest rates are slightly higher than what everyone might have anticipated 2 or 3 years ago. And therefore, if you store money in a government bond or in cash, you are likely to earn a rate of interest. 5 years ago, you wouldn't have earned interest. You could buy 30-year bonds and they would take some money away from you every year, which was a ridiculous situation. But it feels to me things are normalizing. So you briefly touched on that to say, well, reduce your equity exposure if it's correct for you to be at 65%. In the past, 5 years ago, I would have said to you, well, I'm not that thrilled to reduce my equity exposure to go into bonds because it feels to me like return-free risk. I'm not getting a yield, and the price might only go down. Are we kind of arriving in an environment now where where looking at bonds, especially on a global basis, is viable again, where you actually should be looking at it as an asset class to say, I'm not planning to get equity-like returns, but I am sustainably going to get some kind of a return, whether it's yield, whether it's interest on your investment, or potentially some price moves into the future. Is the world kind of back to maybe the new normal that we would have seen, before 2008?
Yeah, definitely. I think if you want to compare different asset classes, you have a P ratio of 28 times. If you invert that, that's earnings per share. It's incredibly low when you compare that to fixed income. So I try and compare asset classes on the same or similar note, right? And globally, what we're seeing here is that you're getting yield profiles. Let's say US 10-year bonds, you're getting yield profiles now in the sort of 5-ish%, right? Which is all based on an inflation assumption of inflation, not necessarily. Okay, two things here. It's based on two things. The one is term risk, which is there's an increased risk in taking on longer term bonds. But the second thing is a relative value opportunity. So people are demanding taking on getting more returns for investing in longer term bonds, because they say, okay, well, if I can get this in equities, then I should get at least this in bonds. That's the logic that's moving markets right now. It's not inflation. So what we've done is we've decomposed the recent move in US Treasuries to see whether it's inflation driven or it is term risk premium driven. And to simplify that, all it's saying is that the market is not saying that higher inflation is here for longer. So we still expect, and the market still expects, inflation to continue to come in. And what I mean by that is maybe not in the next 6 months, but if you're investing for 6 months, that's a very different asset class to look into. If you're investing for the next 5-10 years, then inflation is very important for you, and the expectations of the market are equally as important. So assuming inflation comes in globally and you're getting 5.5% in US Treasuries, inflation comes back down to 2% in the US, then you're getting 3.5% real returns on US Treasuries, which are, relatively speaking, quite a low risk asset class. So, I'm head of multi-asset, and the fantastic thing for me is that opens more avenues for opportunity in global investment opportunities, which haven't existed for the last 10, even 15 years, when yields in the fixed income space were so incredibly low that equities was really the only way to go. Now you've got yields emerging in global fixed income asset classes, which are pretty attractive. Not everywhere. I mean, global credit is still very, very tight spreads, so you're not really paid to take on credit risk yet, but currently you're paid to take on a bit of term risk premium, especially in the United States.
And it feels to me one of the very silent giants of the last 50 years has slowly come out of its slumber, which is Japan. Not a bond market or even a stock market that a lot of us looked at, because they went through such a phenomenal bursting of a bubble and took so long to come back. But even in Japan, it's starting to become possible to see a bit of inflation. They're actually trying to get a bit of inflation and trying to raise interest rates as well. And so, it's been off the radar for so long, but people forget what a phenomenally big country that is from an economic point of view, and certainly something that just we wouldn't have considered for a long time.
Yeah, so you mentioned earlier that the United States has grown significantly within at least the MSCI World Index, to around 70%. Second is Europe. Naturally, it's a lot of countries combined. And third is Japan. So while the US is still a very big component, certainly from a market cap perspective, and I'll come back to that because market cap isn't everything, but Japan is the third largest component of the MSCI World Index, so developed market stocks. So Japan is somewhere to look for opportunities. And as you say, it's now a structural shift and certainly a disconnect from global markets where we're seeing, albeit shallower, but we're still seeing cuts priced in on central banks. Japan is seeing rate hikes priced in. So it's a very different diversifying asset class exposure. So diversified global equities being the key there, and taking on significantly concentrated risk in MSCI World, for example, to US equities, can be a problem unless you diversify that even broader. So for us, for example, we invest into global emerging markets. So we're getting exposure to China, India. And what we've seen this time around, if you recall, the last time Trump took on office, there was the whole trade war back and forth between Trump and pretty much the whole world. And global risk assets sold off especially emerging markets. This time around, we've actually seen something a little bit different. It's saying, okay, well, the US wants to internalize a lot of their capitalist system, so produce goods within the United States, bring markets back into the United States, whereas there are still very much global participants everywhere else in the world, like China, Europe, and even Africa, sub-Saharan Africa, including South Africa. To come back to an earlier point, though, I think it's important to focus on not just where equities are listed, but where they derive their revenues from. And what I mean by that is you can have a company like Apple listed in the United States on the NASDAQ, for example. But they derive, let's say, 60% of their revenues, and this is a complete guess, but it's a large proportion of their revenues from countries outside of the United States. So when we see the NASDAQ selling off or the S&P selling off, that's often just a knee-jerk reaction to news that is published on the day. Back to the news point, it might be news which is trying to inflate some sort of theory of the day, and then that stock sells off. But then people actually start to question things and say, well, hang on, what actual impact would a US-centric policy have on the likes of Apple if Apple's got the majority of its revenue coming from offshore? And that's when you generally see this sort of sell-off and then rebound, because investors come to their senses. So follow the news and then follow the facts. And that's how I see markets continuously playing out. And what it does for us is it creates opportunities to invest. So it's great to have a bit of volatility within global markets.
I mean, back to one of the points, right at the beginning of the show was that valuations count, and you don't get good value unless there is some volatility in it, unless people are unsettled, and then it's having the fortitude to buy the quality assets at a lower price. And maybe, I mean, we're running out of time, but I can't let you go yet, Rupert. You've touched on South Africa a few times, and I haven't been ignoring it. I've been holding it for now, and I feel. It's again at the time of recording, we've had a delayed budget. It's we're not recording before the new budget is promised to be delivered to us. So that's new for everybody in South Africa. Certainly not new for countries that operate in coalitions. But budgets are usually the most contentious thing that happens in a coalition political environment. But it's new for us. And at the same time, lots of sort of court cases around NHI, etc. And it feels to me that a lot of uncertainty, a lot of bad news is priced into South Africa. When you're talking about yields of 11% on bonds, that's a very good yield, very attractive, on a country that's starting to do things right. After doing so many things wrong for so long, we're incrementally taking positive steps as a country. We're slowly sorting out logistics. Yes, every now and then we're getting a bit of load shedding, but still nothing like we've had. And it feels to me that investors, again, should be looking at South Africa much more objectively than potentially we have, and saying, valuations matter. If you've got high quality businesses that have survived so much bad news, and you've got bonds that are offering such good yields that no one's wondering whether South Africa has enough money to pay the interest on the bonds or to repay the capital. That's not the conversation. It's about how much debt we're going to take on in the future, how are we going to spend our money, how are we going to balance the books, but there isn't a concern about viability of the country. If all that's happening, I'm looking at South Africa and I'm saying to myself, you kind of avoid investing in the JSE or in the bond market at your peril, because I think it is cheap, and I think I would love us to be in a situation where we're arguing about getting 4 or 5% GDP growth, economic growth. But if we're just getting around about 1.5 or 2% a year growth, it's not going to solve all our problems, but it's going to make life a heck of a lot easier.
Yeah. Wouldn't that be fantastic? But I think we also, again, can't be naive to the fact that the GNU is, let's call it a loose agreement, and it can fall apart. So I'm always big proponent of diversification. So whilst you do get, and this sounds like I'm completely contradicting myself, but whilst you do get really good yields in South African bonds, and South African equities are attractive right now from a valuation perspective, and you do get paid out for taking on risk, especially in something which we understand, I would argue, more than offshore investors, or we like to think that we do. It's so important to remain objective and to know that South African bonds do have a rocky journey through time, as do South African equities, because of news that might come out, because of changes in assumptions, which can change through the longer term, so say 1, 2, 3, 4, 5 years. Who knows? We could have no GNU in the next elections, a very leftward-leaning or rightward-leaning government. We just don't know at this stage. So it's important to try and diversify yourself as much as possible. We have exposure within our funds, yes, to South Africa, and to the United States. You can't avoid either of them, but also towards China, India, Europe, South America. You can get exposure to all of these asset classes at extremely low cost. And that, to me, and I know it's a very overused statement, but diversification literally is the only free lunch in investing. Because when you are investing into a single asset class, you can get it incredibly right. You can look like the hero fund manager, but you can also get it incredibly wrong. So rather take the, let's say, more risk-conscious road, the boring road, if anything, and just diversify yourself across asset classes.
If he was a cricketer, he would score all his runs in singles, not sixes. That's Rupert Hare. That's my assessment, and that's why he'd never go out and he'd score a lot of runs. So that's probably the only scoring sporting analogy you'll hear on Honest Money. Rupert Hare, I think that's a great place to wrap up. Thank you so much for joining us. I think I couldn't agree more. I think we are in an environment where diversification will help you, number one, sleep at night. Number two, capture some of the growth assets that none of us can foresee will deliver a return right now, and maybe avoid some of the big hidings on assets that we think might be really good investments into the future. He's head of multi-asset at Prescient Investment Management. Thank you so much, Rupert. It's great to have you on the show. I'm probably going to drag you on again, so please get ready.
Thanks so much, Warren, and thanks for everyone for dialing in.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.